Hi there traders and investors. I'm happy to share a regular market review prepared for FxCo portal. Let's get started. Today is December 26, the last trading week of 2022, and we started from USD GPY pair, Irina Monzenko reports. Important information about Japan's inflation growth was released on Friday, December 23. The report's components were all realized either at the level predicted or in the green zone, reflecting the main indicators' continued growth. Despite the USD GPY pair ignoring the article, is not worth discounting Japanese inflation, especially given the results of the December Bank of Japan meeting. Notably, the yen ignored all previous inflation reports similarly because the Japanese regulator, despite the rise in the CPI, kept its accommodative stance while using the appropriate rhetoric. According to Haruhiko Kuroda, the rise in the consumer price index growth rate this year is due to single factors such as the rise in energy prices. In these circumstances, Japanese inflation reports had no bearing on predicting the USD GPY pair's direction of movement. However, as you are aware, things took a dramatic turn in December when the Bank of Japan began to tighten monetary policy guidelines. Given that the central bank has only increased the target yield of 10-year bonds fluctuation range, now it's from plus to minus 0.5%, whereas previously the corridor was within plus or minus 0.25%. This statement initially seems quite bold. On the other hand, the Japanese regulator has consistently implemented ultra-soft monetary policy over a long period, ignoring the general trends of their central banks of the top industrialized nations tightening the DCP's parameters. The idea that the Japanese regulator will maintain an ultra-soft policy at least until the spring of 2023 has been repeatedly put forth by many experts. They only connected potential adjustments to that fact that Haruhiko Kuroda will undoubtedly leave his position in April of next year. The second term in office expires. Therefore, the market responded seriously to even a slight hawkish shift. This is one small step by the Bank of Japan, but a giant leap for the yen, as the press succinctly put in a phrase of Neil Armstrong's famous adage. Indeed, many analysts revised their predictions regarding the next steps taken by the Japanese central bank after the results of the December meeting were made public. Nearly half of the economists surveyed in the most recent Reuters poll think that the Bank of Japan may abandon its ultra-accommodative monetary policy in the first 2 to 3 quarters of 2023. Furthermore, the currency strategists at Goldman Sachs predict that the Japanese regulator will take more drastic action in the future. The central banks may decide in particular to stop entirely manipulating this yield curve. The likelihood of ending the negative interest rate policy is also rising. Nearly every aspect of the aforementioned report performed better than expected in the green zone. In light of the stagnant wage growth, it's important to note that inflation has been above the Bank of Japan's 2% target for 8 months. The yen will benefit from rising hawkish expectations regardless of whether the central bank actually decides to take additional steps towards tightening the PREP or only engages in verbal pumping. Therefore, it's advised to use corrective pullbacks to open short positions on USD GPY pair, as it has most likely not yet reached its southern potential. The levels of 131.60, the lower line of the Bollinger Bands indicator on the daily chart, and 130.60 are the two southern targets in a distance the semi-annual price minimum was reached last week. The next station is the euro-dollar pair. Here is FxCo tone with a medium-term trading. The euro-dollar pair continues to drift sideways since December 18, 2022. The triangle consolidation remains bound between 1.0580 and 1.0640. The single currency pair is seen to be trading close to the 1.0625 mark at this point of writing as traders await a breakout of the above trading range. Probabilities remain towards south side breakout, but prices need to drag consistently below 1.0570. The euro-dollar pair is still holding its engulfing bearish candlestick pattern, which was produced around mid-December after hitting 1.0736 highs. Also note that it was produced around a convergence of Fibonacci retracement and trendline resistance as seen on the daily chart here. Hence bears remained favored to be back in control soon and drag prices below 0.9535. Alternatively, a break above 1.0736 would open the door towards 1.10 and higher levels going forward. For now, traders remain bearish with risk above 1.0750 and a potential target towards 1.0100. We shall review the wave structure again as prices drifted lower to 1.0150 range and decide the next larger degree move. The next in line is Paulo Greco with pound sterling dollar pair. In contrast to the euro-dollar pair, the GBP-USD currency pair is still in motion. Although, based on Friday, there were no noteworthy movements, the pound-dollar pair may also experience a flat in the upcoming months. In essence, there were the same reports from the United States on Friday regarding the pound and the euro, and as we can see, they had no impact on the pair's movement. Given that the reports were so brief, this does not surprise us. The month's major events are all over, and now that the holidays have started, there is no doubt that traders are less motivated to engage in active trading. Technically speaking, the price is still below the moving average and the downward movement is still present. For the past 3 weeks, we have been anticipating a significant downward correction. It's not yet strong, but at least it has something. Since the British economy may experience a severe recession and the Bank of England rate will not continue to rise at its current rate indefinitely, Powell thinks the pound should continue to decline against the US dollar. However, inflation is still out of control, and we have serious doubts that it will start to slow down soon at a rate comparable to that in the United States. This compels the Bank of England to keep tightening monetary policy on the one hand. On the other hand, the third quarter saw a decline in the economy, and officials have predicted a 2-year recession. Tightening monetary policy inevitably means making the recession worse. As a result, we don't think the British regulator will keep raising the rate by 0.5% every time they meet. The period of consolidation might start soon. Over the previous 5 trading days, the GBP-USD pair has averaged 131 points of volatility. This value is high for the dollar-pound exchange rate. As a result, On Monday, December 26, we anticipate channel movement that is constrained by levels of 1.1922 and 1.2172. A round of upward correction will begin if the Heiken Ashi indicator reverses direction upward. On the 4-hour time frame, the GBP-USD pair is trending downward. Therefore, until the Heiken Ashi indicator appears, you should maintain sell orders with targets of 1.1963, blue line on graphic, and 1.1899. And the moving average is fixed above. Buy orders should be placed with targets of 1.2207, blue line on graphic, and 1.2268. We've got a trading plan on gold from Petar Yesimovic. Gold has been trading sideways at the price of 1797, but Petar sees potential for the further rise towards upper references. Due to the strong upside pressure in the background and rejection of the Fibonacci node at 1785, Petar sees potential for further growth. Watch for the potential buying opportunities on the intraday dips with the upside objective at the price of 1820 and 1890. Stochastic oscillator is showing fresh upside momentum, which is a strong sign that buyers are in control. Key support is set at the price of 1775. That's all for today. See you online soon.